Well, hello, everybody, and welcome to another Southern California housing market update. This is for November 22nd, 2022. My name is Stephen Meade with Domicile real estate for people who love houses. And this is kind of an interesting one because things have really kind of moved again a little bit since the last time that we chatted. So a lot has really happened sort of the consumer confidence space, which I think is probably really one of the most important things when we're talking about the housing market. Housing markets tend to be a bit of a self-fulfilling prophecy, right? If 90 out of 100 people think that a crash is coming, they can actually create one. Likewise, if 90 out of 100 people think that the market looks pretty good, they will create a good market. We try to remain objective here. And we have both clients, existing clients that we want to see their investment in a home do well. And we also have first-time buyer hopefuls, and we hope that they have more accessible options for their housing. So we try to keep our viewpoint pretty neutral and not get sort of emotionally involved in looking at the data. That's easier said than done. I think for the most part, we do a good job. So where were we 2 weeks ago? Well, 2 weeks ago, we were talking about some trouble signs on the horizon. And then what happened just 2 days after our last video when we gave an update? Well, the Fed came out with their information on inflation, and it was dramatically lower than expected. And that really gave the markets a lot of confidence. And the bond market actually rallied, lowering interest rates in a rather significant manner. And I think the most important thing that happened for a lot of people is they believed that there was now an end in sight of kind of the inflation crisis, that it was not going to continue on forever, and that the market was indeed responding to some of the measures that the Fed has undertaken. And that's really sort of changed the calculus of things. Now let's go through the numbers. We're going to talk about really what's happening there. So let me pull up our stats for this week. So first off, we've got our total active listings. And one of the things I want to point out here is that we've got really kind of a noticeable downturn in both of these. We're not quite at dropping as fast as we were at this point last year. Well, actually, maybe a little bit more on our 1 to 2 million category, and maybe not quite as much on our under 1 million. And to see sort of these inventory numbers start to drop, that's really telling, right? Because in a market that's maybe in a little bit more distress, or where we're expecting some big price corrections, normally this inventory kind of stacks up towards the end of the year. So to see these numbers start to move down more than they have, I think is kind of an interesting thing to point out. 2 weeks ago, we were talking about how they weren't moving down that much at all. And now it looks like these active listings, this total number of active listings on the market is finally starting to move. Just a reminder, everybody, this is Los Angeles and Orange counties. The blue line is under $1 million active residential listings, and the red line is $1 to $2 million active residential listings in LA and Orange counties. Now, if we look at our new listings, before you get super excited about this information, if you are a current property owner or a seller, understand that this is really a crummy week for listing a house. And one of the things that we've talked about a lot in the past is this idea that holidays don't affect buyers and sellers the same. In general, buyers are more likely to stay in the market around a holiday period, and sellers do not want to put their homes in the market either the week of a holiday or even the week before a holiday. So definitely bear that in mind when you're kind of looking at these numbers, a kind of dramatic fall in listings hit the market. With that said, I mean, these numbers have already been pretty low. The total number of listings hitting the market is significantly down from where we were a year ago today. And you'll see kind of this trend last year. They took a nosedive and then leveled out for a little bit and then dove towards the rest of the year. And again, just as a reminder, this is of the last 2 weeks, new listings hit the market. I don't think the holiday explains entirely this downturn, but it explains part of this. So, kind of temper your enthusiasm a little bit. Now, if we look at our new escrows, these are sort of tailing off in a much more natural way. But what I think is interesting is look at us compared to last year, right? This is gently dropping. Last year, we were in full-blown, people don't really feel like buying houses right now. mode. And then again, we kind of got to early December. They kind of leveled out before kind of diving a little bit to the end of the year and then rebounding in the new year. This is a much more orderly decline in sort of the activity of new escrows. And what has that done, right? When we see listings sharply declining and new escrows only partly declining, well, that bumps up our absorption rate. And as you can see here, both our under 1 million and our 1 to 2 million have now gone into that sort of mid to high 70s% range. You know, that is not a super strong buyer's market. This is going to really push the difference between the most desirable properties and the least desirable properties in the market. You're going to see those least desirable properties really sit, and those ones that people really like. If you walk in there expecting a deal on those desirable properties, you're probably not going to get one right now. If we look at our closed prices, I think this gives you a little bit of perspective. And, you know, we've always tried to divide this up because I think everybody talks about the median home price, right? And, you know, the median home price is a great number to track, but you really want to get some better perspective on the market by looking at that upper 75th percentile and then that entry level 25th percentile. And, you know, what do we see when we look at that? Well, to be honest, we're actually pretty close to where we were exactly a year ago on these prices. You know, down here, we're right around 1.25 million. That was kind of how we were sort of in that beginning spring in our sort of luxury market, right? That upper 25th percentile. Our median market, where are we? Probably right about where we were towards the, you know, beginning of December, sort of a time period, right? And then if we look at our entry level, we're again, right about where we were towards end of November, beginning of December. So we're right about where we were a year ago in terms of pricing on homes. I actually think that's a pretty healthy place for us to be. Everyone is asking questions about what do I think we're going to see in the next 6 months. You know, some big news that came out, or at least it was big news to me, was, you know, CoreLogic, which is a big real estate company, is more or less predicting a 3.9% price growth, more or less nationally for 2023. They've kind of said it's between November and November. They have some little caveats on there, but overall, they're projecting in the next year a net increase from where we are. I'm not sure I feel quite that bullish about things. National Association of Realtors is now predicting a 1% increase, which might as well be flat. Here's what I think is going to happen. I think those kind of, you know, cute little things really only tell one part of the story. I think, you know, we're going to see maybe some mild declines in the next, you know, 90 days. It's obviously going to be very segment dependent, right? Outlying areas are going to do worse. Undesirable properties are going to do worse. Things that look like they came out of a magazine in Newport Beach, they will probably not be affected in any way. And then I think we are going to see kind of a leveling off and maybe an increase. So, you know, what's my advice if you're a seller in a market like this? Well, if you're a seller in a market like this, you want your home to be desirable, right? Like you want to be one of those desirable homes that people are fighting over, because there's a very big difference in price right now between those desirable homes and those undesirable homes. If you are a buyer, now is the time to A, consider those fixer homes, because those are trading at a discount. 2, it's really to keep your eyes open and buy the right house. You know, if we think there's a possibility of a 5% decline in the next 90 days in home prices, yes, with Southern California home prices, that's a lot of money. But I would argue that getting the right house is a lot more important than trying to time that. I think in the long run, you won't care whether you paid $660 or $630 for a house, but you will absolutely care whether you bought the right house or the wrong house. You know, that's just my viewpoint on it. You are free to disagree. If we look at our still active after 14 days in the market, that really came up here through the year and it has really just crested in this area. This number is not continuing to deteriorate any further. And if we go here to our close versus list ratio, remember, this is looking in a rearview mirror, right? Because this stat is based on properties that have closed in the last 2 weeks, which means they were in escrow 4 to 6 weeks ago. And what are we seeing? Again, we're kind of in that 98, 99% level, depending on the price range. This is kind of a normal market, right? Normal is we're between 98 and 100%. Not normal is people routinely paying 107%, 106% of list price per house. That's not normal that would be the average. Now, if we look at our days on market, what do we see? Things really rose up, and then that increase is kind of slowing down to some degree. I think this might be a little bit of an aberration. You'll see there's some fluctuation in these numbers, and now we're right around 40 days. 40 days is actually less than sort of a regular type market. A regular type market is really more like 50 or 60 days, and we're still kind of underneath that. Now, this is the graph that is probably the most important graph that we have, and I want to take a couple minutes. So just as a reminder, what this graph is showing you is we go back to June of 2018, and we basically normalized three things. One is the consumer price index. Two is the rent index, which is the rent on a median single family home. Okay. And then the third thing is the payment on a median priced home using a 30-year fixed rate mortgage. So if we start those all out at the same place in June of 2018, and then we sort of see how these numbers change over time relative to one another, one of the things we talked about 2 weeks ago was this gap, right? And this is the blue line versus the yellow line. And that gap is sort of, you look back here and you see that the rent index and the payment index really moved together up until the beginning of this year. And they weren't that far apart. Then payments grew as interest rates rose and rents followed behind. And what we had was something interesting happened 2 weeks ago when we measured this, right? Our payment was at an all-time high and our rents were at an all-time low. And I said, that disparity cannot exist in the long run. Something's got to give to bring those lines close together. And here's where we are right now. Well, guess what? Rates have dropped precipitously and rents have gone back up. Surprise, surprise, right? And we're seeing this gap closing. I still think it's got a little more closing to do. So it'll be interesting to see how that is addressed. Do we see rents continue to rise? Do continuing interest rates lowering, or do we see prices lower? Those are kind of the levers we have to reconcile this. I'll repeat that just in case anybody missed it. We've got prices, we've got interest rates, and we've got rents. And those are the ingredients that will bring these closer together. Now, there's one little ingredient that we're not talking about, and I think we need to mention it. And I mentioned it briefly, and that is this blue line is based on a 30-year fixed rate mortgage. Back up until probably about this point, most mortgages were 30-year fixed rate mortgages. That is not true after this point. And it's especially not true after this point here. So if you've got a lot of buyers using an adjustable rate mortgage where it might be a percentage point lower for that 5-year ARM or that 7-year ARM, or new home builders are doing buy downs or other things that are sort of affecting this payment line, the reality is that these are actually a bit closer together than it would appear if we were to look at what are consumers actually paying on a monthly basis based on the type of loan they're getting. So that graph might need a little bit of adjustment to sort of correlate to the fact that the mix of loans being used is not necessarily a 30-year fixed rate mortgage. So, overall, how do I feel about this graph now? Well, I feel a lot better about this graph versus 2 weeks ago. 2 weeks ago, I said, we've got a big problem. This is a very big gap between these 2 points, right? It's a gap that looks a lot like this gap, which is not good. What's interesting to me here, though, is look at this rental history. We've got room for rents to go back to this point somewhere in this neighborhood. And if they do this and you account for those adjustable rate mortgages, these, in fact, might be in line with one another. We're just not exactly sure on that if that were to happen. So I don't think we're in this position of extreme market disparity as we were 2 weeks ago. The outlook is quite a bit different. Really, that combination of interest rates and some slight price, reductions has really brought this payment line down quite a bit. And then, of course, we've got inflation here just plugging away. Now, you might be worried about this disparity. I will tell you, historically, over time, the cost of housing has outpaced inflation, period. So it's not unusual to see a widening gap. By the way, if you ever want the real advertisement for why people should buy homes in the long run, that alone should do it for you. That housing costs tend to go up faster than inflation over time. Now, if we look at our prevailing mortgage rates, that really tells the story of why these payments have eased quite a bit. And again, this is prevailing 30-year fixed rate mortgage rates based on a national level. We are more into the mid sixes about now. But again, if we look at that product mix of what kind of mortgages are consumers actually getting, well, most consumers are going for that ARM loan where that rate might be below this 6% level. It might be down in here. Well, that's all I've got for you. Really an interesting update this Thanksgiving week. One of the feelings that I get too is that consumers are really in a bit of an analysis paralysis mode right now. And what I mean by that is they're just not certain how to make decisions. Sellers, buyers alike. One home builder recently called it a frozen pipe, right? It's a pipe that still flows water, but everything is frozen for the time being. I think this inflation news will help thaw that pipe out. And I also think getting past the election has helped thaw that pipe out. We know how Congress is going to look going forward. I think once we get through kind of these holidays, which is normally a very slow time in our market, I think we're poised for a pretty healthy market going forward into the new year. That's how I feel about it today. We'll see you again in 2 weeks. We'll give you an update with more updated information. Questions and comments, as always, we love them. If you are looking to buy or sell real estate in Los Angeles or Orange counties and you would like expertise that is a level up, definitely hit us up. We would love to talk to you. Don't forget to like, subscribe, and hit that notification bell. And we'll see you again real soon.